Silver just had a massive shift, and here is why it matters right now. This is a COMEX alert that you cannot afford to ignore. If you have been watching the precious metals market over the past few days, you have probably noticed the sharp movement, the volatility, and the uncertainty that has gripped traders from New York to London. But here is the truth that the mainstream financial media will not tell you. The price moving up and down on your screen is just the surface noise. The real story, the massive shift that just happened, is occurring deep within the machinery of the COMEX, the commodity exchange that sets the global price for silver and gold. And what just took place inside that machinery is not a normal market fluctuation. It is a structural crack. It is a signal that the game might be changing in ways that most retail investors are not prepared for. So in this video, we are going to separate what is real from what is just hype. By the end, you will walk away feeling calmer, clearer, and far more confident about what you are actually buying, and more importantly, why you are buying it. Today is Thursday, February 19th, 2026, New York time. Drop a comment below and let me know the exact day and date you are watching this from. I love seeing where and when you are tuning in. And real quick, if you appreciate content that is built from scratch, thoughtfully researched and never copied, support the channel by subscribing and commenting Henry's Market HQ below. It helps this channel grow more than you think, and I truly appreciate it. Now let me ask you something. Have you ever stopped to wonder why the price of silver can drop 20 cents in a single minute on no apparent news? Have you ever watched the charts and felt that sick feeling in your stomach when your physical investment loses value on paper for seemingly no reason at all? You are not crazy, and you are not imagining things. What you are witnessing is the collision between two completely different markets. On one side, you have the physical market. This is the real silver. The bars, the coins, the rounds that people hold in their hands, store in their safes, and pass down to their children. This market is driven by supply and demand, by industrial consumption, by the reality that silver is used in everything from solar panels to electric vehicles to medical devices. This market is tight. It is getting tighter every single day. Miners are struggling to keep up with demand. Inventories in London, the global hub for physical bullion, are reportedly strained. If you try to buy a large quantity of physical silver right now, you will wait weeks for delivery, and you will pay a significant premium over the spot price. That is the reality of the physical market. But then there is the other side, the paper market, the COMEX. This is where the price is discovered, or at least where it is supposed to be discovered. This is a market of futures contracts, of promises to deliver silver at a future date. It is a market dominated by algorithms, by high-frequency traders, by banks, and by speculators who have never held a single ounce of silver in their entire lives. In the paper market, you can trade millions of ounces in the blink of an eye without ever touching the metal. And here is the massive shift that just happened. The relationship between these two markets, the paper market and the physical market, just changed in a fundamental way, and the epicenter of that change is the COMEX. To understand why this matters, you have to understand how the COMEX really works. Most people look at the price of silver on their screen, and they assume that price is a reflection of reality. They assume that if the price goes down, it means silver is less valuable. They assume that the market is efficient, that it correctly prices in all available information. But the COMEX is not a pure reflection of supply and demand for physical metal. It is a leverage machine. It is a casino where the number of paper contracts outstanding, the open interest, far exceeds the amount of actual metal available to deliver against those contracts. This is not a conspiracy theory. This is basic market structure. The COMEX allows traders to buy and sell contracts that represent ownership of silver, but only a tiny fraction of those contracts ever result in physical delivery. Most are cash settled or rolled over before expiration. This system works fine when everyone is playing the game by the same rules. It works fine when traders are happy to take cash instead of metal. It works fine when the price is stable and confidence is high. But when confidence breaks, When traders suddenly decide that they want the real thing instead of the paper promise, that is when the machinery starts to grind. That is when the massive shift happens. And according to the latest data coming out of the COMEX, that shift is happening right now. Let me walk you through exactly what just occurred, because the numbers are staggering. In the most recent delivery period, we saw a surge in the number of contracts being stood for delivery. When a trader stands for delivery, it means they are not accepting cash. They are saying, "No, I want the silver. I want the actual metal deposited into my account." This is expensive. It is logistically complicated. Most speculators never do it. So when a large number of traders suddenly decide to stand for delivery, it tells you something profound about their expectations for the future. It tells you they do not trust the paper price. It tells you they want to get their hands on the real asset before something breaks. And that is exactly what we are seeing. The COMEX registered inventory, which is the metal that is available to back these contracts and available for immediate delivery, has been dropping like a stone. At the same time, the open interest, the total number of outstanding contracts, remains stubbornly high. Do you see the math problem here? If the people holding those contracts all decided, at the same time, to demand delivery, there simply is not enough metal in the COMEX warehouses to satisfy them. The exchange would have to declare force majeure. It would have to default. And in the world of commodities, a default at the COMEX would be an earthquake. It would shatter confidence in the entire paper pricing mechanism. Now, here is where it gets really interesting and where the suspense starts to build. The big players, the ones with the deep pockets and the inside information, they see this coming. You can tell by the way the futures curve is behaving. You can tell by the widening spreads between different contract months. You can tell by the way the banks are adjusting their positions. The smart money is quietly positioning itself for a scenario where the paper price and the physical price decouple. They are preparing for a world where you cannot simply look at the COMEX price and know what an ounce of silver is actually worth. They are preparing for a world where physical silver commands a massive and permanent premium over paper silver. And if that happens, if that decoupling becomes the new normal, then everything you think you know about investing in silver is about to change. The price you see on your screen might become increasingly irrelevant. The real action, the real value creation, will happen in the physical market, where supply is constrained and demand from industry and investors is soaring. This is the massive shift that just happened. It is not a flashy event. It did not make the front page of the Wall Street Journal, but beneath the surface, the tectonic plates are moving. The foundation of the paper-silver market is cracking, and when that foundation finally gives way, the fallout will be felt by every single person who owns silver, who is thinking about buying silver, or who simply cares about preserving their wealth in an increasingly uncertain financial world. So as we move forward in this video, I want you to hold on to this understanding. The recent price action, the ups and downs, the volatility, that is just the surface noise. The real story is the structural shift happening in the COMEX vaults. The real story is the growing gap between paper promises and physical reality. And the real story is that you, as an individual investor, have the power to position yourself on the right side of that divide. You do not have to be a victim of the system. You can choose to own the real thing. You can choose to ignore the noise and focus on the signal. And that is exactly what we are going to keep doing together. Stay with me, because in the next section, we are going to dig even deeper. We are going to look at the specific mechanics of how this COMEX shock is playing out in real time. We are going to identify the key indicators you should be watching so you are not caught off guard when the next leg of this move happens. And most importantly, we are going to talk about what this means for your portfolio and your peace of mind. The market is changing. The rules are shifting. But if you stay informed, if you stay disciplined, and if you stay focused on the fundamentals, you will not just survive this shift, you will thrive because of it. Now let us go deeper into the machinery, because understanding the mechanics of what is happening on the COMEX is the only way to protect yourself from the fear and confusion that most investors feel when they watch the price bounce around. You see, the average person looks at a chart and they see chaos, they see randomness, they see a market that is impossible to understand. But when you understand the structure, when you understand the incentives of the players involved, the chaos starts to look a lot more like a pattern. It starts to look like a game with known rules, and more importantly, it starts to look like a game you can win. The massive shift that just happened in silver is not just about inventory numbers and delivery notices. It is about the psychology of the market. It is about the breaking point where trust in the paper system finally gives way to the demand for physical reality. And we are watching that breaking point approach in slow motion right before our eyes. The suspense that is building in the silver market right now is almost palpable to those who know where to look. It is the quiet before the storm. It is the tension you feel when you know something is about to give, but you do not know exactly when. And in this section of the video, I am going to show you exactly where to look so you can see it for yourself. Let us start with the concept of backwardation, because this is one of the most powerful signals in any commodity market. In a normal, healthy market, futures contracts for delivery in the future trade at a higher price than contracts for immediate delivery. This is called contango. It makes sense because there are costs to storing physical metal, insurance costs, financing costs, and the seller needs to be compensated for tying up their capital. So normally, if you want to buy silver for delivery 6 months from now, you pay a little bit more than the current spot price. That is the way markets are supposed to work. But when the market flips into backwardation, when the future price is lower than the current price, it tells you something completely different. It tells you that people are desperate to get the metal right now. It tells you that there is a shortage, or at least a perceived shortage, of physical material available for immediate delivery. It tells you that the market is willing to pay a premium to own the real thing today rather than wait for a paper promise tomorrow. And guess what just started happening in the silver market? We are seeing flashes of backwardation. We are seeing moments where the nearest futures contract trades at a premium to contracts further out. These are not sustained moves yet, but they are happening. They are appearing in the data. And every time it happens, it is like a warning flare going up over the market. It is the market screaming that something is wrong with the plumbing. Now combine that backwardation signal with what is happening in the options market, because the options are where the smart money places its biggest bets. When you look at the options chain for silver, you see something fascinating. There is a massive buildup of open interest in out-of-the-money call options. Options that pay off if the price of silver goes much higher. But here's the twist. The biggest positions are not in the nearby months. They are in the months further out. 6 months, 9 months, even a year from now. What does that tell you? It tells you that the big players, the institutions, the hedge funds, the people with access to the best research and the best information, they are positioning for a move that takes time to develop. They are not betting on a quick spike next week. They are betting on a structural repricing of silver that unfolds over the course of this year and into next. They are betting that the cracks we are seeing in the COMEX system today will widen into a chasm by the time 2026 draws to a close. And they are putting real money behind that bet. This is not some internet forum speculation. This is real data from the options exchange. This is the footprint of institutional capital moving into position. But here is where the suspense really starts to build, because there is another factor in play that most people are completely overlooking. It is the role of the banking system. The big bullion banks, the ones that dominate the COMEX, they are in a difficult position. For years, they have operated a business model that relied on the paper market remaining dominant. They profited from the leverage. They profited from the ability to create and extinguish contracts without worrying about physical delivery. But now the world is changing. Their clients, the big institutional investors, the family offices, the sovereign wealth funds, they are starting to ask harder questions. They are starting to demand physical delivery. They are starting to look at the inventory reports and wonder if their counterparty risk is piling up. And the banks, they are caught in the middle. They have sold millions of ounces of paper silver that they do not actually hold in their vaults. They have relied on the ability to settle in cash or to roll positions forward indefinitely. But if the clients keep demanding delivery, if the open interest keeps getting converted into physical metal, the banks will eventually have to go into the market and buy that metal. They will have to compete with everyone else for a shrinking pool of available physical silver. And when that happens, when the banks become forced buyers instead of willing sellers, that is when the price discovery truly begins. That is when the market stops being about speculation and starts being about survival. Think about the sheer scale of the disconnect. The COMEX at any given time has futures contracts outstanding that represent hundreds of millions of ounces of silver. But the total registered inventory available to deliver against those contracts is only a fraction of that amount. It is like a bank that has lent out 10 times more money than it actually has in deposits. It works as long as everyone trusts the bank and no one asks for their money back all at once. But in banking, we call that a run. And in commodities, when everyone asks for their metal at once, we call it a default. The COMEX has rules to prevent this: position limits, delivery stops, the ability to settle in cash. But rules can be changed, rules can be bent, and when the pressure becomes intense enough, when the physical market is screaming for metal and the paper market is printing contracts, the rules will be tested like never before. The question is not whether the system can hold forever. The question is whether it can hold until the big players get out of the way. And right now, the data suggests that the big players are not getting out of the way. They are doubling down. They are adding to their long positions. They are standing for delivery. They are forcing the issue. And this brings us to the most important point you need to understand about this massive shift. It is not a prediction of immediate doom. It is not a call that silver is going to the moon tomorrow. It is a recognition that the probabilities have changed. The risk profile of the silver market has fundamentally shifted. The chances of a dislocation, of a decoupling, of a price shock are higher today than they have been in years. And the smart investor does not wait for the shock to happen before taking action. The smart investor prepares while the preparation is still easy, while the physical metal is still available at reasonable premiums, while the market is still functioning normally. Because when the shock hits, when the headlines start screaming about COMEX defaults and delivery failures, the opportunity will be gone. The physical metal will either be unavailable or available only at prices that make today look like a bargain. This is the nature of every major market dislocation in history. The people who profited the most were not the ones who reacted to the news. They were the ones who saw the cracks forming, who understood the structure, and who positioned themselves before the crowd caught on. So let me ask you directly, are you going to be one of those people? Are you going to look at the data we just discussed, the backwardation signals, the options positioning, the inventory declines, the rising delivery demands, and decide that this is worth paying attention to? Or are you going to wait until the story is on the front page of every newspaper, until your neighbor is talking about it at the barbecue, until it is so obvious that everyone is already in? Because by then, the massive shift will have already happened. The price will have already moved. The opportunity will have already passed. The time to pay attention is now, while the signals are still visible to those who look, while the noise has not yet drowned out the signal, while you still have the chance to act from a position of calm and clarity rather than fear and desperation. In the final section of this video, we are going to bring it all together. We are going to talk about what comes next, the critical levels you need to watch, the events on the calendar that could trigger the next leg of this move, and most importantly, what you should actually do about it. Because information without action is just entertainment. And I did not create this channel to entertain you. I created it to help you navigate these markets with confidence and purpose. So stay with me. The best is yet to come. Now we arrive at the most important part of this entire discussion. We have laid the foundation. We have looked at the mechanics of the COMEX. We have examined the signals in the options market, the backwardation flashes, the inventory draws, the rising delivery demands. But none of that matters if we do not answer the two questions that are probably burning in your mind right now. What happens next? And what should I do about it? because the goal here is not to scare you. The goal is not to make you feel anxious about the future. The goal is to equip you with the understanding you need to navigate what is coming with your eyes wide open and your portfolio positioned for strength rather than weakness. The massive shift that just happened in silver is not a reason to panic. It is a reason to pay attention. It is a reason to think differently about how you approach this market. And in this final section, we are going to cover the specific levels, the specific events, and the specific mindset shifts that will determine whether you come out of this cycle feeling victorious or feeling like you missed the boat. Let us start with the technical picture, because even though the real story is fundamental, the market still expresses itself through price. And right now, the price of silver is sending us some very clear messages if we know how to read them. After the recent sharp move, silver is sitting at a critical juncture. We have resistance levels above that have been tested multiple times over the past year. Every time silver has approached these levels, it has been met with selling pressure. But here's the difference now. The selling pressure is not coming from the physical market. It is coming from the paper market. It is coming from the algorithms and the speculators who are betting on lower prices. And historically, when the paper selling meets physical buying, when the speculative shorts try to push the price down but the real demand for metal keeps absorbing the supply, that is when you get the setup for a short squeeze. That is when the sellers get trapped and are forced to cover their positions by buying back contracts at higher and higher prices. The data suggests that we are approaching exactly that kind of setup. The speculative net short position in silver futures has been building. The commercial hedgers, who are usually on the other side of these trades, have been reducing their short exposure. That is the classic precursor to a significant move higher. The smart money is getting out of the way of the train, and the speculative money is standing on the tracks. But the technicals are just one piece of the puzzle. The real catalyst, the thing that could light the fuse at any moment, is an event. And there are several events on the horizon that you need to have on your radar. The first is the next COMEX delivery period. Every time a futures contract expires, we get a fresh look at who is willing to take delivery and who is rolling over. If the trend of increasing delivery demands continues, if more and more traders decide to take the metal rather than the cash, that will put additional strain on the already depleted registered inventory. And at some point, the exchange may be forced to take action. They may raise margins, they may impose position limits, they may do things that temporarily disrupt the market. But in the long run, those actions only delay the inevitable. They do not solve the underlying problem, which is that there is far more paper silver in circulation than there is physical silver available to back it. The second event to watch is the behavior of the big ETFs, particularly the SLV, the largest silver ETF in the world. The SLV holds physical silver in vaults on behalf of shareholders. And for most of the past few years, the shares have traded at a slight premium or discount to the net asset value, nothing dramatic. But if we start to see the premium widen significantly, if the shares start trading at a substantial premium to the underlying metal, that will be another signal that the physical market is tightening. It will tell you that investors are willing to pay extra just to get exposure to silver, even if that exposure is through a paper vehicle. And that kind of demand eventually flows through to the physical market because the ETF has to buy metal to back new shares. So keep your eye on the SLV premium or discount. It is a simple indicator that can tell you a lot about the mood of the market. Now let us talk about the geopolitical and macroeconomic backdrop, because silver does not exist in a vacuum. We are sitting here on February 19, 2026, in a world that looks very different than it did just a few years ago. Inflation, despite the headlines, has not been vanquished. It has been suppressed by aggressive central bank policy, but the underlying pressures, the debt, the money printing, the structural supply chain issues, they have not gone away. They have just been kicked down the road, and at some point, the road ends. At some point, the bill comes due, and when it does, when the next wave of inflation anxiety hits the markets, precious metals will be front and center. Gold will get the headlines, but silver will get the leverage. Silver is both a monetary metal and an industrial metal. It benefits from inflation fears, and it benefits from economic growth. It is the hybrid. It is the double threat. And in a world where industrial demand from green energy and technology is rising steadily while mine supply struggles to keep pace, that combination is potent. But here is the mindset shift that I want to leave with you because it is the most important thing you will take away from this video. Stop thinking like a trader and start thinking like an owner. When you own physical silver, you are not betting on the price going up tomorrow. You are not gambling on the next jobs report or the next Fed meeting. You are opting out of a system that you do not fully trust. You are choosing to hold wealth in a form that has no counterparty risk. You are buying insurance. And insurance is not something you buy because you expect the house to burn down tomorrow. You buy it because you want to sleep well at night, knowing that if something does happen, you are protected. That is the mindset of the successful silver investor. It is not about timing the market perfectly. It is about having a foundation of real assets that will hold their value regardless of what happens in the paper markets. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early, because we are going to keep covering this story. We are going to keep watching the COMEX inventory. We are going to keep tracking the delivery notices. We are going to keep cutting through the noise to bring you the signal, and I want you to be part of this community as we navigate these uncertain times together. So let me leave you with this final thought. The massive shift in silver is not a prediction of doom. It is an observation of reality. The cracks in the system are real. The data is clear. The signals are flashing. What you do with that information is up to you. You can ignore it and hope that everything works out. You can wait and see and react when the news hits. Or you can act now from a position of strength while the opportunity is still available. The choice is yours. But whatever you choose, do it with your eyes open. Do it with understanding. Do it with confidence. Because at the end of the day, this is your wealth. This is your future. And no one cares about it as much as you do. So take what you have learned here today. Apply it to your own situation. Make your own decisions. And know that whatever happens in the markets, you have the tools and the mindset to handle it. Thank you for watching. Thank you for being part of Henry's Market HQ. I will see you in the next video.